All right, so we are going to work on this problem, and we have all these transactions from the 1st through the 30th of July. This is way too much for us to take this entire problem through all those steps in the accounting process. So I'm going to break them up just a little bit, trying not to make the videos too long, but not too short either, so that we don't have 100 videos. Okay, so let's go through these. We have the very first one. It says two individuals invested 30,000 in the corporation. Each investor was issued 3,000 shares of common stock. Okay, 30,000 each gives us 60,000. So we will debit cash and credit common stock. Okay. Second entry, we're going to borrow $40,000 from the local bank. We're going to and sign two notes. The first note is 10,000, requires payment of 10% interest in 6 months. The second note is 30,000, requires a payment of principal in 2 years. Interest 10% is payable each year on July 1st and July 1st, 2029. Okay? You just got a whole bunch of information to make this one small entry. Okay? You are still just going to debit cash and 40,000 credit notes payable. You do have two notes here though. The first note has a principal of 10,000, interest rate of 10%, and it is for 6 months. Okay? The other one is for 30,000, and that interest rate is also 10%, but it's over 2 years. Okay? Now, we do need some of these dates. I'm hoping they'll give it to us when we get down to making adjusting entries. They probably will. But most of this information from right here to the end, we need all that to do the payments and the adjusting entry. Okay? Don't get too confused when they give you this long transaction and you're thinking you got to do something with all those numbers. You don't have to do anything with all those numbers. The only thing that is happening right now on July 1st is you're borrowing $40,000 in cash. Okay. All right. The next one, we paid 24,000 in advance for 1 year's rent on a store building. Okay. Also, we're going to need this for our adjusting entries later on as well. They said that was for 1 year or 12 months, and this is July 1st. Dates, double, triple underline dates. If you've got a scratch piece of paper, write that down. Okay, write yourself timelines because that will help you make those adjusting entries. Okay, right here, we're just going to debit our asset, prepaid rent, and credit cash. All right, next entry, we are going to purchase some office supplies. I'm sorry, office equipment from Etronics for $12,000 cash. Okay, we are going to debit office equipment for 12,000, credit cash. We're also going to need this one for our adjusting entry because office equipment is property, plant, and equipment, which will be depreciated. Okay, I'm just guessing they're probably going to make us do that as an adjusting entry on this problem because they take these journal entries and they go through the entire process. Okay. So then we're going to record a purchase of inventory on account. So they said purchase $60,000 of clothing inventory on account from Birdwell Wholesale Clothing Company. They didn't tell us, but they probably should have said this is perpetual inventory system. Okay, so we're going to debit inventory, that's an asset, credit the accounts payable. Okay, remember if it was periodic, and you have to know a little bit more about periodic because it is still tested on the CPA exam. If it's periodic, remember we don't keep up with the inventory throughout the year. That inventory account would be called a temporary account called purchases. Okay. So, but most businesses actually use perpetual and then they just debit the inventory. Okay. Oh, here they go. I've already done this. I've already told you what the difference is between those. A little review. It's almost like I knew what they were going to say. Okay. Next entry, we're going to purchase $2,000 of supplies for cash. Okay. We are going to debit supplies, the asset. I like to pull that out because this is something they really try to trick you on. And then we're going to credit cash. If they'd have said on account, that would have been accounts payable. Okay. Next entry. So July 4th through the 31st, they said they sold clothing inventory during the month for 35,000 cash. The cost of the inventory sold was 20,000. Okay. Note the entry reflects the perpetual inventory approach. Okay. Let's get the first entry right. Remember, in a perpetual inventory sale, you're going to have two journal entries every single time. Okay. So we're going to debit cash, credit our sales revenue, but we also have to take that out of the inventory. Okay. So we will debit cost of goods sold for 20,000 and credit the inventory. We're making this inventory go down. Think about Walmart. When you go to Walmart and use the self-checkout, I actually love the self-checkout at all stores because it's one less person touching my stuff and I feel like I can get done a lot faster. I don't really care if I'm working for Walmart. I'm okay with that. I like the self-checkout. And think about you scan something, let's say Tic Tacs. Scan those Tic Tacs. In Walmart system, it's ringing your sale up, but behind the scenes, it's taking it out of inventory because they are always keeping up with how much inventory is leaving the building. Here, this looks like an entry that is covering all of July. Okay. And that's fine. They can do it that way too. It's really okay. But for a bigger place like Walmart and Target, they're going to be keeping up with that. Like there's going to be a daily how much was sold. Okay. All right. And then in the next one, it said we sold inventory on account to Briarfield School for 3,500. The cost of that inventory was 2,000. This journal entry is almost identical to this one right here. The only difference is here we sold it on credit. We didn't get cash here. We got a promise to pay cash. So don't think that you've got two big journal entries you have to memorize. Notice those are identical accounts. The only thing different is that accounts receivable. Okay. And I always like to do the sale first because the sale is always going to be the bigger number. There might be some sales that they are selling at a loss. That would be like if you go to the grocery store once a week and they have some things on sale, they might actually be losing money on those sale items, but they're trying to get you in the door so you'll buy their other items at a more marked up rate. Okay. All right. Then we subleased a portion of the building to a jewelry store and we received $1,000 in advance for the first 2 months of rent beginning July 16th. I can guarantee you this is going to be part of an adjusting entry. So 7/16, and they said that was for 2 months. 1,000 was for 2 months. So it's only going to be half a month because I think they're going to make us do adjusting entries as of the end of July. Okay. We will debit cash and we will credit. They don't really have to say deferred. They- I mean, I guess they do. I like unearned because that's what all of your other textbooks have been saying. So that just makes it sound so different. Unearned rent revenue, deferred rent revenue means exactly the same thing. It is a liability. It is not revenue because on this date, when they gave the cash, we haven't earned any revenue. When we go to make a journal entry, an adjusting entry, 7/31, then yes, we're going to adjust a half a month out and we're going to say, hey, we've earned that half a month of rent. Okay. So we're going to come down here. We're going to pay Birdwell Wholesale Clothing 25,000 on a cash. Okay. We bought all that, we bought that inventory on credit and now we're paying it back. We're going to debit accounts payable for the 25,000 and credit cash. Okay. Next, we're going to do is record payment of salaries. And we are paid salaries to employees for the first half of the month of $5,000. We are going to debit salaries expense for 5,000 and credit cash. Okay, realize that's a very simplified salary wage expense because we did a little bit of tiny bit of payroll back in principles, and like that was a huge journal entry, and that was probably simplified. Okay. Next thing, we're going to receive 1,500 on account from Briarfield. That's who we sold that clothing to, and now they're paying us. So we will debit cash, credit accounts receivable. Okay. Then we're going to record dividends. We're getting close to the end of this one, y'all. So we're going to record payment of dividends. And it said the corporation paid its shareholders a cash dividend of $1,000. Okay. They're using a temporary account, dividends. That's ultimately going to be closed to retained earnings. Okay. So debit dividends for 1,000 and credit cash for 1,000. Okay. Let's do this concept check. It says recording an expense for salaries incurred and paid in cash would be recorded by debiting an expense. And we just did that one right there. Okay. Isn't it kind of neat how they'll ask you a question about something that you just previously heard, kind of like these Edpuzzle videos that I'm doing for you? Okay. I'll jump on. Now we are going to look at posting. Okay. Posting just means we're taking each one of those entries and we're putting it. Remember, I think I made my ledger. It looked like all the T accounts for all the different accounts that we used. Okay. So you can see where the debit of 24,000 went to this prepaid rent. The credit to cash goes to the cash account. Okay. Remember, in an entry like that, this is an asset. This is an asset as well. Did total assets change? No, they did not, because you traded one asset for another. That's a trick question they like to ask you after some of these entries. Okay. So here is all of the T accounts. I'm really glad they didn't make us do all that. They just kind of have it done for us. And you can see when you're doing this for your homework, always make your cash account a lot bigger than the rest of them because cash is going to affect a lot of entries. And then they have wasted space because they put that cash right by prepaid rent. Okay. So we have everything here all posted for us. Okay. These are the balance sheet accounts is what it looks like. Yeah. And then we have the income statement accounts and the dividends. So we have our sales revenue, cost of goods sold, salaries expense. Dividends is not an expense, okay? Not an expense, okay? So the next thing we're going to do is prepare that unadjusted trial balance, okay? And all those journal entries, I think it kept saying it was what step 2 and 3, okay? All right. So here is that unadjusted trial balance. They pulled all these numbers from this ledger all the way up here. They grabbed that balance. They grabbed this balance. They grabbed that balance, that one, that one, that one. Okay, that's all they're doing is grabbing the balances in each one of these accounts and putting them into the trial balance. Okay, this is the unadjusted trial balance because we're going to make adjusting entries in this process. Okay, so that we will pick up in the next video on doing the adjustments